Welcome back. Now, OPEC Plus nations are gearing up to discuss the November oil output policy. It is anticipated that the oil cartel and its allies will hike production significantly, with reports suggesting that it could be triple the increase made for October. This amid weakening demand for the commodity. Just how does this impact the outlook for the crude market? Vinesh Chetty, head of energy commodities at Afriforesight, joins us with his analysis. Vinesh, thanks so much for your time this afternoon. Let's start with the basics, right? What have you made of the recent price dynamics? Brent has been under pressure for most part of the year, briefly hitting a 4-month low earlier this week before recovering, but still trading around that $65 per barrel mark, down from roughly $68 a week or two ago.
You're absolutely right. We're certainly seeing some downswings. Some of that is a seasonal factor. Northern Hemisphere transition from summer to winter, traditionally less travel, less demand for petrol and jet fuel. We're seeing a lot of that. We are also seeing, as you've said, OPEC Plus looking to continue to add oil onto the market. More supply, decrease in demand fits together for generally declining prices.
And you just mentioned my next point, right? One of the triggers for the decline we've been seeing is chatter that OPEC Plus could raise output by 500 barrels per day, though the group later denied it. Interestingly, it seems like some analysts are saying the rumor might have come from OPEC officials to sort of gauge how the market could possibly react. How are you reading what has been, out, some of these media reports?
So you are right, 500,000 barrels a day is a large increase, significantly larger than previous months. We see this sort of information generally ahead of an OPEC meeting. Each month we often tend to get some leaks ahead of time, some ministers talking to us. So this is fairly usual to get pieces of information in the lead up to the meeting. But you are correct, a 500,000 barrel per day increase at a time of relatively weak demand, relatively low prices would be a large increase.
Now, if OPEC were to actually add that much supply into the market, Vinesh, a market, as you mentioned, already seen as oversupplied, what would that signal to you about the group's confidence in future demand?
I think right now the big thing they'd be chasing is market share.
Yes.
There certainly are concerns about long-term demand for oil. We're seeing a shift towards more fuel-efficient cars. We're seeing a shift towards electric vehicles and hybrids. But the OPEC Plus group tends to have lower cost of production, particularly a country like Saudi Arabia has incredibly low cost of production. And the fact that it tends to have state-owned companies, they don't need to report those quarterly profits that your big private companies would have to. So there is an argument that they're chasing high production volumes, and that puts downward price pressure, which hurts your private oil producers more than those state-owned companies.
I find it interesting that even if you look at some of OPEC's reports, they're estimating even higher demand come 2026, even though we're seeing what's playing out at the moment. Are we seeing a divergence, Vinesh, between OPEC's internal demand models and how traders and markets are actually pricing oil?
It is always an interesting one because while OPEC is still seeing that rising demand, we're seeing some other energy analysts talking about us heading to peak demand. I always say it's worth remembering who's doing the research, who's doing the study. Even the best economists, even the best scientists, sometimes there is a little bit of pressure if you work for an oil producing organization to maybe, lean into we're still seeing rising demand. So there is an argument that OPEC is a little bit over optimistic on rising oil demand.
And obviously, they'd like to get that into the market to somewhat proper prices. All right, beyond OPEC, Vinesh, how much of a spanner in the works has the U.S. government shutdown had on oil markets, given, some of the disruptions we could see from that?
I think your biggest thing there is going to be your information. You're getting less and less information. So we're not going to get US jobs numbers and the like. The US Energy Department is going to continue to give us fuel numbers. We received the numbers about US petrol, diesel, and fuel
Okay.
and crude oil inventories yesterday. That will continue, but we're not going to see the number of jobs added. So that lack of information is the major thing there. In terms of actual people without jobs, it's a relatively small percentage of the total US labor force. It's less than 1% of people in the US who were employed that are currently furloughed by the government. So not a significant amount of less driving and the like in the US because of the government shutdown.
All right. And, you know, Russian oil continues to remain a big wild card with, you know, G7 sanctions, the price cap, and efforts to tighten enforcement. How much are these measures actually biting into supply to global markets, and I guess also Russia's oil revenues?
So it certainly hit them on their revenue. Russian oil does continue to sell at a discount to global prices. But in terms of actually pushing barrels into the market, we've really seen a reorganization. Russia now sells the vast majority of their oil to China and India, and some to Turkey, countries which don't follow Western sanctions.
Yes.
But that's really what's happened, is oil that used to flow to Europe and the like is now going elsewhere. So still Russian oil making it to the market.
And when you weigh all these factors, OPEC's supply stance, the US shutdown, G7 sanctions on Russian oil, and I guess the broader macro picture, because there are still those geopolitical issues still playing out, what's your outlook for prices heading into 2026?
So we are forecasting generally declining prices. You've got OPEC continuing to add supply onto the market, and we see generally weak demand. As I said, cars that are shifting to, even the petrol-powered ones, using less petrol per liter, more hybrids, more electric vehicles. So weak demand and rising supply, we see prices declining through 2026. The Afriforesight forecast is about 10% lower dollar oil prices next year compared to the average of this year.
So around the $50 per barrel mark?
We would forecast the $62 a barrel next year, compared to an average of about $69 a barrel this year.
All right, let's leave it there then. Vinesh, thanks so much for your time and taking us through the dynamics playing out in the oil market. That was Vinesh Chetty, Head of Energy Commodities at Afriforesight.